Trump's new One Big Beautiful Act is officially now law, and it changes how a lot of households and businesses should think about taxes moving forward. Here are 10 changes you need to know and how they affect your taxes. But before we dive in, I need to say this clearly. The internet is oversimplifying this. For example, when you hear no tax on tips or no tax on overtime, most people just assume that those dollars magically become untaxed, but that's not how this works. See, most of the big changes in a tax deduction is basically the government saying, we're going to ignore this portion of income when calculating your federal income tax. But that is different from tax-free. And all of these changes come with income limits, documentation, and expiration dates. So it's super important that you pay close attention. So in this video, I'm going to break down what changed, what the tax law used to be, who qualifies, and exactly what you need to know in plain English. And if we haven't met, my name is Kingsley Ifedi. I'm a CPA, certified public accountant, and I specialize in proactive tax planning for high-income business owners and families. See, over my career, I've advised clients across more than 40 states, representing over $300 million in combined revenue. So I've seen exactly how wealthy families and business owners structure things to save thousands of dollars in taxes each year. But before we hop into it, quick disclaimer. Yes, I am a CPA, but I am not your CPA unless you hire me. So this video is for educational purposes only and not tax advice. Tax planning is highly personal and your specific facts and circumstances matter. Let's go in and start with the change that's going to affect a lot of people's paychecks. The first major change with the new tax bill. See, before this law, tips were treated like regular income, meaning if you made $10,000 in tips, then that $10,000 got included in your taxable income. You also paid payroll taxes on all of it, which is Social Security and Medicare tax, as long as it was reported correctly on your tax return. Now there is a new tax deduction for qualified tips up to $25,000 per year, but it's temporary and is currently only going to apply for tax years 2025 through 2028. And there are a few income limits to note. The deduction starts phasing out once your modified adjusted gross income goes over $150,000 if you're single and $300,000 if you're married filing jointly. And it only applies if you're in an occupation that the IRS says is customary and regularly receiving tips. Meaning there are categories of businesses where the IRS says you don't qualify, like certain specified service trades and businesses. So what does all of this mean in plain English? It means you still report your tips on your tax return just like before. You still get a W-2 that includes all of your tips if you're a W-2 worker, and you still pay payroll taxes on them. But you may be able to subtract or deduct up to $25,000 of those tips from your income for federal income tax purposes. Now let me give you a quick example. Say if you earn $20,000 of tips this year and you qualify, so instead of paying federal income tax on the full $20,000, and you'll probably end up paying zero income tax on all of it. But that is just income tax, not payroll tax. And all of that could equal a couple of thousands of dollars in tax savings each year, depending on your tax bracket. But there are a few catches to keep in mind. Number one, it's qualified tips. That generally means actual tips, not mandatory service charges. So if you're working at a restaurant, that automatically adds a service fee that may not count the same way that a tip would, since it is not voluntarily received from a customer. Number two, there are guardrails to prevent abuse. The government doesn't want every company turning wages into tips overnight. So there are rules around eligible tipped occupations and reporting. Number three, there are income limits. Once again, just like I said before, once your modified AGI goes over $150,000 if you're single and $300,000 if you're filing joint, the deduction starts to phase out. And number four, it does expire after 2028 unless they decide to extend it. So don't build your entire life plan assuming that this will last forever. The practical move for tips is simple. Don't play games, don't stop reporting tips, don't let your employer get creative. Track your tips, report your tips, and make sure your tax filing includes them correctly so that you can claim the deduction that you qualify for. Okay, second, overtime. This is a really big one that a lot of people are talking about. So before this law, the big beautiful bill, overtime was just simply wages. If you worked 50 hours, your check was bigger, and all of that was income. All of that got taxed just like normal wages, and it was all subject to payroll taxes. Now, what changed? Now there is a temporary deduction for qualified overtime compensation, effective for tax years 2025 through 2028. The maximum tax deduction is $12,500 per year if you're single, and $25,000 per year if you're married filing joint. And it does start to phase out once your modified AGI goes over $150,000 if you're single, and $300,000 if you join. But this is where most people get it wrong. It doesn't mean that your entire overtime paycheck is untaxed. See, in plain English, it's generally tied to the overtime premium or the extra part above your normal pay rate. Let's take, for example, say you make $20 an hour and your overtime rate is $30 per hour. The extra $10 is a premium. So the benefit is generally tied to the extra $10, not the full $30 overtime hour. That's why I tell clients, think of it like the government is helping you with the extra portion of overtime, not necessarily all of the overtime wages. And again, just like tips, overtime is still subject to payroll taxes. So what should you do? But the big takeaway is this: overtime is not suddenly untaxed. It's simply a tax deduction, and it comes with rules. Hey, I quickly wanted to mention, if you are an employer, quick plug right here, payroll is about to matter even more with these new tax rules, especially for tracking wages, tips, and clean reporting. I personally use ADP, and I've got an ADP rep who can get you a really great discount and white glove service, meaning he'll set everything up for you from end to end. And if you want that sweet discount and helping your business get set up correctly with payroll, the link is in the description. Now let's talk about the third tax change. The third change is the car loan interest deduction. See, before the big beautiful bill, car loan interest was basically personal interest, and personal interest generally does not get a federal tax deduction. So even if you paid $3,000 a year in car interest, the IRS was basically like, that's personal spending, you don't get a tax deduction for it. Now what changed? Now there's a temporary deduction up to $10,000 per year for interest on certain vehicle loans, and it applies for tax years 2025 through 2028. But the requirements are a little strict. See, in layman terms, here's how you should think about it. This is not all car interest is now tax deductible. This is some people financing certain new vehicles may qualify for a federal tax deduction on some or all of the interest they paid throughout the year. And the big things you need to know are: 1, the loan has to be a qualifying loan, generally originated after the end of 2024. 2, the vehicle must be brand new, meaning it has not been previously titled or owned. A used car doesn't qualify even if it's new to you personally. 3, the vehicle has to meet the US final assembly rules, meaning it must be assembled in the United States to qualify. 4, leases don't qualify. So if you lease, you don't get this tax deduction. 5, there's an income phase out, meaning higher earners can lose the benefit partially or even fully, starting at $100,000 single and $200,000 joint. And 6, the tax return does require documentations like the VIN number, meaning the IRS wants this traceable. So the action step here is, if you're buying a car and you're specifically counting on this deduction, don't assume, confirm. Ask the dealership about the final assembly, confirm whether you're financing or you're leasing, and tell your CPA before you purchase it, because it's easy to plan wrong here. Now, let's move into the changes that affect a much wider group of taxpayers. The people who don't earn tips, don't work overtime, and aren't buying a car. The standard deduction increase. Here's the fourth change in the bill, the standard deduction increase. See, the standard deduction is basically an IRS freebie. It's basically the government saying on your first certain amount of income, you don't pay income tax. See, itemizing your deduction is the other option. Instead of taking that standard deduction freebie, you pretty much add up all of your deductible expenses like mortgage interest, state and property taxes, charitable giving, and all of the other itemized deduction, and you only choose the itemized route if all of your itemized deductions are greater than the standard deduction for the year. See, before the Tax Cuts and Jobs Act back in 2017, in the older rules, the standard deduction was much lower and much more people itemized their deduction. But then the Tax Cuts and Jobs Act in 2017 basically doubled the standard deduction, which caused a lot of people to stop itemizing. The problem was that many TCJA individual provisions were scheduled to expire at the end of 2025, which would have caused a lot of people's taxes to shift. What changed with this new law? This law continues the higher standard deduction structure, and for 2025, the standard deduction amounts are $15,750 for single filers and married filing separately, $31,500 for married filing jointly, and $23,625 per head of household. Now, this does typically increase to adjust for inflation each year, so check the current year's standard deduction. Here's the practical impact in plain English. Most people will still not itemize the deductions since their standard deduction is much higher. But if you have significant itemized deductions, such as a lot of mortgage interest, it may be worth running an analysis to see if itemizing or taking the standard deduction is better for you this year. Which brings us to our next topic, salt. And no, I'm not talking about seasoning. I'm talking about state and local income taxes. See, the fifth change that the new bill brought was a salt tax increase to $40,000. See, before the TCJA, salt was basically unlimited for many itemizers. Then the TCJA back in 2017 introduced a $10,000 cap, meaning if you paid $30,000 in state income tax and property tax, you could only deduct up to $10,000 if you itemized. That cap was a huge deal in higher tax states like New York or California. Now what changed? Now, if you itemize, the salt cap is now up to $40,000 instead of $10,000 where it was in previous years. But there is an income limit. That maximum salt deduction is reduced once your modified AGI goes over $500,000 married filing jointly and $250,000 if you're married filing separately. But here's the key that most people miss. This only matters if you itemize. If you take the standard deduction, this salt cap increase won't matter for you. Even the fact that it does move up to $40,000, it won't change your tax return. So the real move is this. If you live in a higher tax state, or if you own a home with high property taxes, rerun the math this year. See if itemizing your deduction is a better move now that the salt cap has increased. Because some households that used to take the standard deduction might find out that now itemizing starts to make more sense again. But let's go ahead and recap the changes. Number one, tips deduction. Qualified tips are now deductible for a limited time, but it does phase out at higher income levels, and you still need to report everything on your tax return. Number two, the overtime deduction. There's a temporary deduction tied to the overtime premium portion with caps and income phase outs. Number three, car loan interest deduction. Interest on certain U.S. assembled vehicle loans can now be deductible for a limited time with a little bit of eligibility and income phase out requirements. Number four, the higher standard deduction has been extended. The higher standard deduction now continues, which means a lot of people still won't itemize the deductions, but the higher standard deduction means more money back into your pockets. Number five, salt cap increase. The salt deduction cap increases to $40,000 for a period of years. Then it is scheduled to revert later unless they extend it. See, the biggest takeaway is this. This bill doesn't just cut taxes, it changes the rules. And with taxes, the people who win are the people who understand the rules early enough to plan. And if you're watching this thinking, okay, I'd love to have a tax strategy plan to pay less in taxes. That is called tax planning, my friend, and you've come to the right place. See, tax planning is exactly what me and my team specialize in for families and business owners. Click the link in the description or pinned comment to learn more about working with me and my team. And if you learned something new today, do me a favor, like, subscribe, and share this with somebody who's working on their own wealth journey. Until then, keep building and keep keeping more of what you earn. I'll see you in the next video.